Let me say something that might surprise you. Day trading is not hard because the charts are complicated. It's not hard because the indicators don't work. And it's not hard because the markets are rigged. Day trading is hard because it exposes human weakness at full volume. If trading was pure mechanical, algorithms wouldn't outperform humans so consistently. But they do, because they don't feel fear, greed, boredom, or the need to be right. Today, I want to break down what actually makes day trading hard, using real data, real world analogies, and things I've personally seen wipe out traders, even the smart ones. Let's start with the biggest one: emotions. Fear, greed, FOMO, revenge trading. According to a well known study by Barber and Odin, retail traders consistently underperform the market, not because they lack intelligence, but because they trade too often and emotionally. Overtrading alone can reduce returns by 6 to 7% per year. That's not a strategy issue, that's psychology. FOMO is seeing a move already halfway done and thinking, if I don't get in now, I'm missing the whole thing. That's like jumping onto a moving treadmill at full speed, wondering why you flew off. Greed is when your plan says, take profit here, but your brain says, just a little more. This one could be big. Greed doesn't usually blow accounts immediately. It slowly erodes discipline, and until one oversized loss wipes out the weeks of gains, then you blow your account. While fear shows up as cutting winners too early, hesitating on valid setups, or moving stops for no reason. Stops, higher up than you need to be risking. You can have a 60% win rate strategy, but if fear causes you to sabotage winners, the math just stops working. While revenge trading is the most dangerous emotion of them all, you no longer trade the market, you're trading your ego. And as we should already know, emotions don't need to be anywhere near trading. Trading is strip the two away. If you're trading just your ego, you're bound to shoot yourself in the kneecap, if you would. It's the equivalent of losing a hand in poker and immediately going all in just to get your money back. Why would you do that? And statistically, that's how accounts died. I've been there, you've been there, we all have been there. Another massive reason why day trading is hard is strategy hopping. One week it's VWAP scalps, the next it's ICT concepts, then it's supply and demand, then it's some indicator that you saw online having a 97% win rate and you didn't even backtest. You saw it, bam, you're instantly using it. Here's the reality. Most profitable traders don't have secret strategies. They have one or two edges executed the same way every day. It's boring. Some days you get up and you sit in front of the chart and you go, God, this is the most mundane job I could have. But that is real trading. Imagine going to the gym every day and doing chest on Monday, legs on Tuesday, and then quitting because you don't see your abs by Friday. No one expects a physique transmission in 1 week, but traders expect profitability in 5 trades. It doesn't make sense. Markets reward depth, not novelty. If you never stay with a strategy long enough to experience drawdowns, you never let probability play out. You're not failing because of the strategy, you're failing because you're not giving it enough sample size. It's like flipping a coin, and people know a coin flip is 50-50. Well, it's like 49-51, but if you flip it, it's 3 times. What are the odds that you get all heads? It's relatively high. What about all tails? It's also pretty high. But if you flip that same coin over 1,000 times, what are the odds you get 500 to 500 or 510 to 490? Right, your odds start to close in and you see the true percentages. Most losing traders are reactive and not proactive. They open the charts and think, let's see what happens. That's not trading. That's speculating with money. I see it all the time. I see people, they come in, they're playing video games and they're like, let's hop in the charts. Just like you would if you and your buddies are playing Xbox or something. They sit down, open the charts, and right away they go, wow, this is an A+ setup. What are the odds that every time you sit in front of the charts, you see an A+ setup? Personally, I feel like those are pretty low odds. I've set a chart hundreds of times, and many days I've seen no setups. Many times I open my phone, I look at the chart, and there's no good setups. So what are the odds that every time you look, you see an A plus setup? Super low. So why would you trade every time you open? Why would you react in the sense of that, right? Professional traders plan where the price should go to, where they would be wrong, what invalidates a setup. These are all things that are done before you enter the trade. It's planning. Reactive traders, they chase the candles. They enter the mid move. They deal with the FOMO and let emotions decide when they need to cut trades or when they need to move their stop loss even higher against and drawdown so that they stay in the move. And I've been that trader before. I've done that, all of this, so many times, and that is why I think I can tell you that's not the way to profitability. According to prop firm data shared publicly, traders who predefine entries and stops before market opens have a significantly higher survival rates than those trading impulsively. Who would have thought? This is like driving without a GPS, waiting until you miss your exit, then swerving across 3 lanes to fix it. If you do that, I already hate you. You're going to put my life and everybody in my car and other cars at risk because of your stupidity and lack of preparation. Why would you do that? Good at trading feels boring because most decisions are made before the trade even exists. This is the equivalence of every morning when I'm doing my pre-market analysis, I usually have 2 options. I want to see price do X followed by Y so that I can do Z. Or, and there's 2 of those. It's either it goes up or it goes down, and look for this, that, and yada, yada, yada. Another reason why traders constantly fail is because they're following the gurus without backtesting them. Following gurus is not the problem necessarily. There's plenty of great ones out there, and they all, to some degree, have good information. The problem is blindly following them. If you know me, you know that I share my trades. I constantly host a live stream and all that, and I tell everybody, don't blindly follow me. If this is your first time listening to me trade, is what I would say, hang out, paper trade behind me. Don't risk your own money. You have no idea. What if I'm full of crap and you're about to risk your hard-earned money off of something that some random guy says? It's a really bad idea. That's a really, really bad idea. So you have to backtest the gurus. You have to backtest the people making the alerts, making the plays, calling it out, just like you would if you're putting your money in a hedge fund. They have a sheet that goes, hey, here are my returns. These are my trades for the last X amount of time. They're good or they're bad. And you decide based on the statistics of, do you put your money with them? Trading behind someone is no different. You don't do it blindly. The SEC has repetitively warned that majority of social media trading claims are either cherry-picked, simulated, or not real conditions. They're fake. If someone's strategy truly worked effortlessly at scale, they wouldn't need YouTube revenue or Discord subscriptions to survive. And I get it right off the bat. I'm sitting here making a YouTube video. And I will prove, 1, I have like 50 subscribers. I'm not making any money off that. And 2, if you want to look at my WAP, there's no money from my Discord. Everybody subscribes to someone else. Everything I own comes from trading profits. And I'm happy to prove it. I'm pretty transparent. If you have me in the Discord, I share my P&Ls, and I don't really share my payouts, but I could. The equivalence of copying someone, whether it be myself or anyone you might know online, is like copying someone's diet, not knowing their genetics or their calorie intake or how hard they're training in the gym, right? Then blaming the diet when it doesn't work for you. It doesn't make sense. And backtesting isn't optional. Just like, if you want to copy someone to a T, maybe you need to make sure that the factors are the same for you, right? If I grab a bottle of tequila and I drink 12 shots and I'm fine, and you drink 12 shots and you black out. Are you blaming the tequila, or are you going to blame that me and you are two different people and that we have two different reactions to the tequila, right? You have to know all factors and how different they can be before you expect the same results like you would with tequila or a diet or a workout plan or any sort of learning ability. We're different human beings. Just like in trading, if you don't know through backtesting the data, then how are you going to know my win rate? How are you going to know my average loss is $500 to $1,000? How are you going to know that I'm comfortable sitting in $400 of drawdown and then I'm turning around and expecting $1,200 to $1,800 profit? If you blindly follow me and we get to a $400 loss and I'm cool as can be and you're not, and you close and then I take profit, whose fault is that? It ain't mine. It's yours. You should have done the research. You should have learned, hey, Sam's pretty comfortable here. I wonder why that is. The big truth that nobody wants to hear is that 90%, if not more, I think it's like 97% of traders lose money. Most traders try it for a month or 2 or 3 and quit, and they lose money. 13% of traders who have ever tried make it past 1 year, and that leaves like 3 to 4% of people who actually have made any money. The odds are against you. The odds are against the masses because the masses don't necessarily know how to control their emotions. Just like we mentioned before, they're reactive. They let their emotions cloud their judgment and act prematurely. And that's going to harm you in trading as if it would in real life. When traders fail, it's because they can't control their emotions. They don't stay consistent. They don't plan. They don't do the back testing or the forward testing. Day trading is hard for the same reason entrepreneurship is hard. It requires emotional regulation, delayed gratification, and accountability. Trading is a business. The market doesn't care how bad you want it. It only rewards discipline over time. If you're struggling, it doesn't mean you're incapable. It means you're fighting your own instincts. And that's the real battle. You have to overcome your emotions and your shortfalls and your flaws to prevail in trading. It's not easy. I really mean that. It is not easy. If there's one thing you take away from this video, understand that controlling your emotions is the first step to the right path to becoming profitable. So if you learned something in this video, if it helped you, let me know in the comments. If you guys want a further breakdown of psychology, risk, executions, and whatnot, drop me a follow or subscribe or whatever, and I'll make some more content. But yeah, just remember, the charts aren't the enemy, that you guys just have to stay disciplined.